large cap healthcare names, it does kick off next week, as you guys know. One would expect few surprises. I mean, coming off a really good AGM season, there was no really changes in the AGMs for the majority of companies. Most of them did reiterate their guidance. In fact, it was only Primer that we saw actually bump up their guidance, or actually debut, their fiscal 18 guidance for, it was actually disappointing, calling for 0 to 5% profit growth. That was 4% below consensus at the time. However, I would say that a seemingly stable and defensive sector, such as healthcare, it is quite volatile as far as earnings reports, and they do tend to surprise us. I would actually characterize the sector as quite bipolar in that regard. So we wouldn't really expect anything less heading into this reporting season, especially we are contending, as James pointed out, with Forex headwinds. The Aussie dollars against the USD is up 4%. We have sizable second half skews for a lot of our names across our universe. And of course, valuation is always a sticking point for my space. These stocks do trade as a whole one standard deviation rich. So anything, or any sniff, I should say, of a problem in the halves, a lot of these things would actually be affected by gravity and be pulled back down to earth. I did put out a note, so sorry I don't have any slides up right now. I did put out a note, however, yesterday I would refer that to you, talking about our thoughts of what we're looking for, what consensus is, what's our outlook as well, for all the names that are due, as I said, to report next week. However, I will highlight just a few names right now. The key gist is we do see downside risk for Cochlear, HealthScope, and Primary. Quickly for Cochlear, they're really fighting against a growing cost base. They're looking for product upgrades or upgrade cycle. 25% of their profits driven by this. The problem that they're having is they only recently launched their new product, so it really hasn't had time to kick in. So the first half, I think, is going to be quite a weak print. All the growth, in fact, is skewed to the second half. They're shooting for 12% growth. We're at 9, consensus is at 12. But as I said, everything's going to be baked into the second half. Trading at 35 times, there's not much room for error here. What I feel with this name, since it's such a market darling, if there's any kind of weakness on the half, it seems to be a buying opportunity. People pile in if it does sell down. For HealthScope, we talked about this ad nauseum, so sorry before. Continued weak utilization across the healthcare market we saw as far as hospitals are concerned, and the market knows it. This is the 4th or 5th most shorted stock on the ASX. 13.5% of the register roughly is shorted. It is also facing costing pressures, trying to get the business model correct, and brownfields. Now, these brownfields, these capacity expansion programs, they're on time, they're on budget, that's great, but they are currently a drag to the P&L. They're not adding to it, they're taking from it, obviously. The first half is guided to be down on the PCP. So really the question for us really is how negative is negative going to be, and can they fill the second half hole to get back to just kind of a flat growth for the year? Given the market sentiment I feel for this name, it's really not going to be answered in the first half. You're going to have to wait, I feel, until the August result for the full year to answer that question. Then again, if the first half isn't that bad, and if we do have more positive sentiment or belief that the second half can recover, this thing will be short squeezed of the likes of unwinding of the short vol trade that we're seeing right now outside the U.S. Moving on to Primary quickly, business is in transition. I've said this before, really a revamped GP business model trying to get through that. Remember, is 30% of their profit for the medical centers. Really uncertain trajectory of their pathology. That's the remaining part of this business. Really lingering concerns here for different contract changes that have gone through recently, as well as cost structures. We have really a price inflation on the consumable business. That said, investors here for Primary have bid up this name. It's trading actually on a forward multiple that's similar to Sonic, 18 times roughly. I think that's unjustifiable, but what it is due to is potential takeout here. 16% of this register is owned by Chinese Zhonghe, and people believe that's a potential takeout. And with all the activity in this space right now with M&A, that could come to fruition. I'd also move on quickly. We do see risk in CSL as well as Ansell. Really looking for upgrades into this half, really to sustain their upward momentum. These stocks are trading at 5-year high multiples on a PE basis. CSL, certainly the North America flu season, it's been quite bad. They really need that to continue into this half to really sustain their momentum in that division. That's about 25% of their business. They really need new products to bump up as well that they recently launched. to kind of push the top end of their fiscal 18 guidance, which is calling for 16% growth. We're sitting at 16, the street's at 18, so they're already there. They need to push that higher to move the stock anymore. As I said, this is going to be hard, I believe. The first half, people don't really realize this, but they can see they're comping a very high hurdle in their plasma division. 22% growth they put up in the first half of last year. That's really difficult because this market grows at high single digits. So in my brain, in my model, it's only low double digits. It can be hard to replicate that or to go past that. The plasma inventories of this business are not replenished as of yet, so they're having a hard time filling full demand. That's a problem, as well as competitive threats across the space are heating up. So first half is going to be quite interesting for CSL, but kind of like Cochlear, for CSL, market darling, no really different. If the thing sells off, people tend to buy the dips. Ansell, quickly, our top sector pick coming out of the year and result has worked quite well. It's up 20% versus the broader market, up a couple points, give or take. Really on the base of the reinflation trade. Synchronized growth we're seeing across the planet, still ongoing, so no problem there. There should benefit from cost outs. The biggest bugaboo, I guess, for lack of a better word, is really the peaking of the raw material costs. So this represents a big chunk of this business. They did peak last half, but we should be reflecting in the first half that we see this reporting season. But we're looking for them to upgrade as well to kind of sustain the momentum because they're trading at 18 times. This is for an industrial name, seems rich to me. Lastly, I will talk about Sonic Healthcare, medical diagnostic lab space. I like this stock for fiscal 18, as I said previously. Really should hold its own in the first half. Don't see really any problems. We're looking at benefiting from improving lab growth. That's 80% of this business is pathology labs. Domestic business really doing well. Medicare data is up almost 13% in pathology. That's a nice print for them. We see upside of further consolidation in this market. It's all about scale business. Very easy business model for Sonic. It's about scales and synergies. And you're looking for that because you're facing regulatory risk in the U.S. and the market's consolidating. This has $500 million on its balance sheet as far as headroom is concerned. So you look for more acquisitions. So I do like Sonic into the result.